All right, who thinks this stock is undervalued? All right, who thinks it is overvalued? Couple, good. Fairly valued, or that there's insufficient information? Well, I think the majority got it. It is undervalued, correct. Yeah. So, walking through this, if we just have the formula here, or a better question, which of these two are we going to use? Well, we look at the question and it tells us it just paid. That is a key. When you see that on your test note, just paid or previously paid or two-day paid, that's going to be a D0 because you're always standing at time 0 unless you're doing two-stage and then you're moving around on the timeline. But assume you're standing at time 0. If it just paid it, we know we're going to use this. So in this case, we're going to use our dividend payment 201 times 1 plus the growth rate, which we were given was 4%, and then divided by K minus G. The question told us that it was 13% required rate of return, and the growth rate was 4%. And then just another thing that I like to do is always leave percentages and decimals, whether you're doing bonds or like on the last test when you did like the expected return and standard deviation. If it makes more sense for you to do 13 minus 4, that's great. But for me, I just always leave it in decimals, and then I never have the error of accidentally doing like 13 minus 0.04 and getting, 12 point whatever. So just leave those in decimals. Then we solve for this. It was priced at 22.41, and we valued it at 23. So it was priced undervalued. And I don't want you to get confused with the terminology of overvalued, undervalued. When we are doing these processes, we're finding the value of an asset. What is it worth? What should it be priced at, right? And there's some questions that assume that it's efficient, because markets in reality are efficient. If you go out and you find Google stock is this, that's probably what it's worth, because there's a million analysts doing these things and buying and selling it. And by supply and demand, it's going to be the right price. But just to make test questions, we're assuming it's mispriced. So when we do this, we're finding the value, and the price cannot be the value. Because I know that it can be tricky sometimes, wait, okay, is this over, undervalued, especially with bonds. So just figure out what works best for you in that sense, so that you don't make an error of doing the right calculation but then getting the wrong answer because you get confused with under and over. Yeah? Correct. The two-stage definitely does. The two-stage combines because you'll do something like this, plus you'll take it back each year. I don't think he's going to take from last topic, but definitely for the final, there's going to be some really long problems where it's first solve the cap M, then get a rate, then use that rate in discounting it back. So questions can easily build off each other. For this test, I don't think they will that much. All right. Just a conceptual question. Which of these will increase the value of common stock? We just have to look as far as our equation, right? D1 over K minus G. This is the value of it. So higher growth rate is going, yeah. And I guess algebraically it looks confusing, but just remember that a lower number in the denominator makes the whole answer higher. And so because you're minusing this, it will. And that makes sense intuitively, right? If a common share is growing faster, it's worth more. So yeah, the answer is C. It's the higher growth rate. Smaller dividend. If we're going back to our example of all finance is cash flows, if these are smaller, then that's the value is obviously going to be smaller, higher required rate of return. It's just the whole pencil trick. It applies to bonds and everything else of price versus like your required rate of return. As that goes up, your price is going to go down, or value in this case. So for different components. We'll not do this one, but just be ready to solve for different components of it. So, right, they could say most of the time solve for the value this stock, or they could say the value of this stock is $50. The dividend was, $2.50. K is 11%. Solve for G, basically. And so then you'll just have to use algebra to do that. Do you want to try and go over this, or are you all good with like the algebra? So going back to if the keywords, right? So if it says just paid, so first identify, they're going to tell you a dividend, identify if that is today or tomorrow. Because if you already are given, all you're doing when you're multiplying it by 1 plus G is just getting T1. For this question, I have, let me see. How much stock is currently selling for its expected? Investors believe the expected required return. What is the constant growth rate? So just kind of like I was explaining, in some of the question, like most of the time, markets are efficient. Most of the time it will be priced. So if it doesn't tell you a price and then ask you a value besides it, just assume that that is the correct value. And especially for this, like really every question is, what do I have? What is it asking? And so like, it didn't give you anything other than that $50, so you don't need to worry about it, right? So you just, what do I have? Find what's the unknown. So yeah, we'll skip that. Let's get to some two-stage. Perfect. All right. I think this is the biggest thing to learn, so let's all work on this one. I'll give you some time, and then we'll go over it. Oh, wait a second. Someone showed me this question in the lab, and it was a bad question. Make sure it's rate of 5% forever. Current stock price. I think, yeah, in the lab someone showed me to this, and I think it does. It's confusing because it's not clear, and I think the question actually has the next 3 years starting at time 0. So let's actually do a different question. Let's see what it was. 12% next, like the one I saw on the answers on the My Educator, it said that like there's different ones. Sometimes it'll say for the next 3 years. So like on your timeline, you don't have to worry about this, but just real quick, right? This is one. For the next 3 years, 12%. Is this the 12%, or is the 12% here, right? And I think there was other issues with this problem as well. Let me check. I don't remember who I helped with that, but yeah, that one was a bad one. So instead of that one, let us do question. Yeah, this one's a little. No, that's bad. Let's see. Okay, let's do this one. Let's do 21. Are there any TAs here now for Finance 201? All right, great. We would usually help you individually, but I'm going to have some words with some people, so it'll be fine. Let's see. All right, so let's go over this one. So this one, it tells us the dividends they're going to pay, right? So it tells us 3, 5, 7, 50, whatever, 10. And on these, it's pretty crucial that you draw the timeline. But that's my advice all the time. Draw the timelines. Because then you won't get the cash flows confused. But still, people try to just do it in their head. I don't know how. But So first things first, draw the timeline. And if you do that, you'll realize, okay, these are my cash flows. And that first thing I started at the beginning, finance is taking cash flows, bringing them back, right? So then if we had done that, we'd say, okay, this 150, let's see, they last paid this 150. Now, if this was a question that told us, the dividend's going to grow by 3%, we would need to use this 150, right? But in this case, it's just in there. It's a red herring. We don't need to worry about it because they tell us what the cash flows are. And if we had drawn out the timeline, we could just realize, okay, that was past. Forget the 150. So we give out the 3, the 5, the 750, the 10, and then it tells us we have 250 for forever. So this is going to be our constant growth. So this was our super growth right here. And then this is going to be our constant. And then by default, because we know it's a fixed payment, the 250 each time, we know we're going to use our preferred stock. It doesn't really, I don't think it tells us anything about being a preferred stock, but we know consistency, fixed payments, preferred stock. So this 250 goes forever. So then we're going to value it, right? So, see that just a little higher. We do that, and we get, at least I got, $16.66, 67 cents. Did other people get that? Right? Great. So then I think this is where the trip up comes. And Dr. Holmes has gone over this again and again. Where are we going to put this on our cash flow? On year 4. Perfect. Remember this for so many different things throughout even the course of this class and the next tests. Always just remember to keep track of the subscripts and where on your timeline it goes. And that's right. We're going to put this at time 4 because if the formula tells us value at time 0 equals the dividend of time 1 over k. And so here, 250 is the subscript 5. And so the value, since it's just 1 less, is going to be subscript 4. And so that $16 value is the value of this stock from the cash flows that go on forever for the preferred portion of it at time 4. So then what we can do is, once we know that, there's kind of 2 ways to do this. You can either, I guess I need to keep the whole thing. Can't really see that. But we can take, so this $10 up here is also in time 4. So a little bit of a shortcut is you can just add the $10 to the 16 because they're both in the same time period. If they're both in the same time period, they'll both be discounted by the same factor. If you do it algebraically, that'll make a lot of sense since you use your calculator, maybe not, but just know that's true, that you can discount at the same factor. So just to save a step, I added these together, I got 26, and I discounted that back 4 years on my calculator. And I think we're all pretty good at that. And then I did the same thing for 750, brought that back, n equals 3, obviously, 2, 1, and then those are all the values I got. And then I added it all up, and I got 2657. Any questions on that? Or am I? You can tell me I'm wrong too, because I might be. I don't know for sure. Okay. Yep. So let's just do this 26, right? I would just do 26.667 as my future value. Plug that in there. And then I know that it's 4 periods, so I do 4n. I know it's the rate hasn't changed. It's still, well, it told you it was 15%. So I do 15 as my IY, and then I just solve for present value. It gives it to me as a negative, but I just know that's just because how the calculator works. And so I'll just take the absolute value. It's a 1525. Oh, the cash flows function. Well, you're going to have to use the cash flow function for the next test. Okay, we'll take a vote on this. I can teach you something. Well, okay, that's fine. You'll wish you had known it the next test beforehand, But I don't want to, even if there's one student who gets confused, I don't want to do that. But yeah, the cash flows will save you so much time. Because instead of having to do each one back, you just plug it in and then put in a discount rate, and it solves it for all of them. But we'll save that till Dr. Holmes teaches it, I guess. I can show you maybe after, or if any of the TAs show up, then they can help you with that. All right. Yeah. That is actually a good question. So back up here, if I understand your question right, is we have this $1.55 dividend they told us about, right? When it comes to Gordon growth, and it comes to these, and it tells you they just paid a dividend, don't worry about it. You're only using it to project in the future. But there were questions in the last topic when you need to, so if the question asks you something about you need to have this much money to pay for college or something like that, and let's say you paid for college, this is why it's confusing. If you paid for college and you start, so college starts today, right? But you've been saving up your whole life for it. So you put in cash flows to get there. And if the question asks you, how much do you, well, so let's say let's say you started college at 18. How much money do you need to have today? And then it tells you college is going to cost you $5,000 each semester. In that scenario, the money you need to have saved up in your bank account, you would include this time zero period cash flow. But when it comes to stocks, forget about it. But in the case of if you need money to pay for it, you will want to add that to it. Because it's kind of a funny thing. It's like you have this much money and you immediately pay $5,000 in the same time period. Whereas with the stocks, you could think of it as like you got a dividend December 31st at 11:59 p.m. Now it's January 1st, 12:01 a.m. And so it's in the past, even though they're kind of at the same point. So just know, if it's dividends, if it's Gordon growth, don't worry about the zero payments except for to calculate the future. But if it's like a cash flow payment like the ones we did in the last chapters, you will want to add that back to it if you're solving for it. I hope that didn't confuse too many of you. But know that, I guess. Was there a question? Someone else? I thought I saw a hand. All right. Okay, we've gone about 40 minutes. Do we want to move on to, what was I going to go to after this? Leverage? Chapter 10? Should we move to chapter 10 then? All right, cool. Okay, topic 10. Know the different financial leverage, calculate, interpret margin, break even, calculate, interpret. So are you guys struggling more with the interpretation of leverage or how to calculate leverage? Interpretation. Yeah, we have a TA. Woo! So if you have any questions, you can raise your hand. That's great. So interpretation. This was a graph he had on his slides. And so I kind of broke them out in my PowerPoint here. So we have, if this is a graph of time and our costs, this is our revenue line, right? Or I guess not time, sorry, quantity. Okay? If I'm selling watermelon, the more watermelon I sell, the more money I'm making, right? I think I gave this example in class. Fixed cost, that's, let's say I had to buy, I think the example I used was a truck. If I had to buy a truck, I'd pay that up front, right? Those are my costs. So I don't really actually make profit until my revenue line crosses my cost line. Does that make sense? So once I sell enough, and that's where your break-even point is once I've sold enough units where I pay off the truck, that's break-even. Then you also have variable costs. So it's $3 to buy a watermelon, $4 to sell it. So I'm making a contribution margin of $1 each time, and that's the difference between the yellow line and the black line, right? But the difference between these two is that, I'll go down, it's further here, no. So think of your EBIT as your earnings. In the case of only fixed costs, so let's say that the watermelon were free and all I had to do was sell them, right? If I only have fixed costs, if I don't sell enough, I have a loss. With just fixed costs, my leverage is higher. It's magnified. And remember that it's a two-edged sword. Good times are better, bad times are worse. Really remember that. So in this case, in the bad times, it was really bad. Whereas if I had just the variable costs, and let's say I only sold 5 watermelon, well, I made $5, but I didn't lose anything. I'm not in the negative, right? And so then what I've done with this graph here is you can see that my good times, so let's say that red line lined up with 100 watermelon, my earnings are magnified. They get larger because I've used fixed costs rather than variable costs. And I guess the watermelon example is not as good. Think of like Redbox, right? So let's say I paid someone to go door to door to sell DVDs. That'd be variable costs. For every DVD they sell, I give them something. A Redbox machine, there's no variable cost to it. It's fixed cost, and it just sits there, right? So a Redbox machine would just be the yellow line. So if I do really well on my Redbox, I paid it off a long time ago at my break even, and I made a lot of earnings. But if I didn't, I had lost, yeah?
You just talk about examples of like occupations. You talk about the physician, but conceptually, I guarantee there's going to be a question like that on the exam.
About
kind of, what would fall that, just something along those lines where we can just be more familiar with what kind of job would be more
a fixed cost job?
Fixed or
well, I mean,
kind of like what you were already going on right there.
Yeah, the doctor case is just they have a lot of equipment. They have to pay their secretary's office fees, right? So they have a lot of fixed costs, and so their earnings are magnified. So the last 5 days, they've already paid off that. So that it takes them a while to get to their break-even point, but once they do, they're really highly levered, and so then their earnings are giving them they're returning a lot of money off that. I guess summer sales would be the opposite example, right? The more you sell, the better you do. But I guess you have your fixed costs. You had to fly out wherever you went. But forgetting that, like if you don't make any sales, well, that stinks. But you're not in the hole. You didn't have to buy something to sell something. So that's kind of an occupation example, maybe. Let's see if there's a. Okay, so then the format you'll probably most likely see this on is an income statement, right? So on your income statement, you start it with what you make, and then it breaks down and net income. And then something I've noticed with a lot of the questions is also know that they're not the same thing, but earnings per share and return on equity are also factors of net income. So like if the question says, how much did earnings per share go up? You'll be like, well, what is that? I know that the formula tells me net income. Just know that those are the same name for they're not the same thing, but they're related, so the percentage growth will be the same. So sorry, what? They could be asked in the question as a filler for net income. So in leverage, as you probably read about, you have the business risk and you have finance risk. In both cases, it's because you have fixed costs. So your variable costs, in this case, cost of goods sold is a variable cost. And again, I apologize for people who haven't had accounting. You're a bit at a disadvantage. But variable costs in this case are your cost of goods sold, and then operating expense would be your fixed costs. If you go down the balance, then you're given with EBIT, and know that EBIT has a synonym which is your operating profit. You might see that on the test as exchange for EBIT. I don't know. Then you take out interest expense, your taxes, and you get down to net income. So the thing to note here is that the thing that's really affecting it is fixed costs. Fixed costs in the terms of I bought a warehouse, or fixed costs going back to debt versus preferred stock versus equity. Debt is a fixed cost finance, because interest expense you have to pay every time or else you go bankrupt. So that 182 is always the same. It doesn't vary with sales. Neither does your operating expense. It doesn't vary with sales. Everything else on here varies with sales, even taxes, because it's just a portion of sales. So that's kind of intuition. I saw it, yeah. So that was a bond. So we can get to that. When we did our raise, I don't know if you heard at the beginning, we just said chapter 10 and 7. And I know that Anna's going to go over the next hour. She'll probably do duration. But do you guys want me to go over duration? How much more of this do you want? Because we can do a problem of leverage.
Just finish this?
Yeah, we'll I can do that. Let's finish this. Okay. I actually used this question in the class I taught as well. Financial leverage is bad, or neither good or bad. It is D. Remember that it makes the good times better, bad times worse, but there's not really like an advantage to, well, let's make more money by levering higher. Well, that's up to the management to decide. Okay, that's what we went over. The formulas will be there. It'll be sales minus variable costs over EBIT. That's how you calculate it. So honestly, I don't think this is going to be that hard for you guys to solve. You'll have it. You'll figure out. You have to interpret what is your variable cost, what is your fixed, what is your sales and EBIT. So just know like EBIT could be operating profit. But once you get that, you'll get a number for DOL. And then the key is just to interpret a DOL. What does that mean? What does a DOL of 3 mean? It means that if my sales go up by 5%, then my EBIT, what did I just do? Whatever. EBIT will go up by 15%. If it went down by 5, it would go down by 15, right? So just remember, degree of operating leverage is that first section of it. It goes from sales to EBIT. DFL is just the second half. It's just saying if EBIT goes up by 15%, so let's say our DFL was 2. So if EBIT went up by 15%, then I know that net income went up to 30%, by 30%. So you would also then interpret the numbers. So you'd say, you would solve for this. So if they said, given this, what is a 5% change in sales going to do to net income for the next year? And these aren't the right numbers, right? You would solve it out with this, but you would come down here, you'd solve, and remember it's multiplicative. He says that in class, it's not additive. So you can either go each step or just say 2 times 3, okay, that is 6. So that means my net income is going to be 6 times the 5%. The DCL on the left side, right? You can go from the top to the bottom. You just multiply it across. That will also give you the 30%. Then you'll say, okay, I know that net income is going to go up by 30%, so I'll do 1.3 just to keep it the same. This 3 represents my 30% times 307. What did I just do? Okay, 1.3 times 3. Then I find out that my new net income is 399. And that's kind of how a question would ask you. It'd be like, what is the new net income? And so first, you solve for these. So first step, solve for DOL, DFL, or DCL. Second step, determine percent change in sales. And then the third step, apply that Well, it could be either asking you EBIT or net income. So apply that to whatever it's corresponding to. Oh, okay, yeah. I don't know. So really, I think these will come to you pretty easily after you do a few of the problems on the chapter questions. I don't think they will. I don't think they unless they gave you the DOL and DFL. You would just go opposite. On your formula sheet, it'll tell you it's just percent change in EBIT over, so like DOL also equals percent change in EBIT over percent change in sales, which makes sense because in this case, that's 15 over 5 gives me 3. So it's all algebra. It's all just algebra. So I mean, that's possible. I really don't think they would do that on the test.
So really quick, there's like a portion in the reading for this chapter that has like optimal capital structure with Modigliani and
Don't worry about it.
Don't worry
Yeah,
about it?
for this, you don't need to worry about that.
Okay.
If you go into finance, you'll talk a lot about that, and it talks about like the pie and what's the optimal level. Yeah, so.
It just shows you all the stuff with no taxes, and bankruptcy costs.
Right.
But don't worry about that.
Yeah, you won't need to worry about that. No. I know we kind of only like focused on operating leverage. We didn't get a good overview, but is there any other questions for leverage? Also, the question could give you, it could say units. So it sold 100,000 units and they were priced at $5. They cost $3, right? And then it will tell you, they have fixed costs of 200,000 or something, right? Or not, I'll just say 50,000. Okay, if they give it to you in this format for a leverage problem, my advice is you can multiply 100,000 by 5, 100,000 by 3 to find the difference, or just find the difference between the two. Your unit contribution margin is just what you price it at minus your cost. So in this case, it'd be 2. And so it'll tell you just sold 100,000 units, right? And then it'll ask you leverage questions. Just get down on your income statement by just saying 2 times 100,000. So then I have $200,000, which is the equivalent of my sales minus variable costs over EBIT. That 200,000 is here. Fixed cost is 50. Then I would just do 200,000, which is the equivalent of this. So it's the equivalent of my gross profit on this thing. This is equivalent to gross profit. I'm sorry, I'm writing everywhere. But anyway, that's your gross profit. Then you take out your fixed costs. GP means gross profit minus FC, which is fixed costs, will give you your EBIT in this case. So that'd just be 200K over 150K. So just be familiar with this kind of format versus just an income statement. Just be able to make an income statement. So if you're not familiar with that, practice that. Know how to go down. And that is just super messy. I apologize. Let's talk about duration. Unless there's any last questions on leverage. I would know duration, yeah. So we have a relationship, yield to maturity and price. When yield to maturity goes down, our price goes up. Fundamental. And that's what you're going to need to draw on for duration. Now, duration tells us that bonds that are longer distance have higher risk because they're over longer time. Duration is literally what it means, duration of time, right? And so if I have a bond A, bond B, and this one is 10 years, and this one is 5 years, because I'm getting my money back later. So remember, you get $1,000 at the end of a bond. Because I'm getting that back later, bond A will, all else equal, have a higher duration. Is there a hand for me or for? Okay. So duration is a measure of time. Okay. So that's a principle to understand. And then, if it's riskier, a change. So let's just say in this example, yield to maturity changed by, it went up by 1.5%. Okay? Which of these bonds' price will be more affected, is what duration's telling us. And because this one is longer in time, it's going to be more affected. So bond A, they're both going to go down, because remember, the inverse, right? So bond A will go down by, let's say, well, let's just do bigger arrow. Bond B will go down by smaller arrow. Right? It'll go down by less. We'll say this was, well, if duration was 3 for, well, never mind. I saw a hand. Yeah. What's left? Yeah. I mean, it doesn't matter if this is 0 or if you're comparing two bonds and it has 5 years or 10 years. Yeah. Their duration will change with how much time's left. So, and the duration will be a multiplier. And it's interesting, but it's in terms of average years. So let's just say the duration here for A was 3, so my math can be easier. And then B, because it's shorter, let's say it's 2. So this big arrow change was a drop by, and again, just like leverage, we're just multiplying it across. 1.5 times 3. So that's going to be 4.5% decrease in price. This one, 1.5 times 2, it's going to be a decrease in 3%. Yeah, you will not have to calculate duration. They will give that to you. Correct. Now, and I want you guys to listen close to this. There's one other factor in duration, and that is the coupon payments. Okay? The risk is that I'm getting my $1,000 back in 10 years, and I'm getting my $1,000 back in 5 years. But bonds also give us coupon payments. So a smaller coupon payment is going to increase my duration risk. Okay? So if I have two bonds that are both 10 years, okay? A and B again. So this is kind of a new concept. If this one has coupon payments of $30 and this one has payments of $50, the number I get back for duration for this one is going to be higher. So it would be like B is like duration. You see that? B will be a duration of, let's say, 6, and this will be a duration of, let's say, 3, because it has smaller coupon payments. So I think I have a slide on that somewhere. No, it's all the way up in bonds. Okay, there you go. So know this, that the two things that make duration larger is longer time to maturity and smaller coupon payments. So it is possible, it would be possible for a bond that is 8 years and this is 10, it would be possible for this to have the higher duration, depending on its coupon payments. So duration will be given to you. So these are the two things to know. Know the multiplicative, hope that's spelled right, effects, or just how to work of duration, which is simply your duration times yield to maturity gives you the percentage change in price. That's the first thing to know. And then 2 is just this. Know the duration is affected by length of time and coupon payment. Any questions on that? Yeah. There's not a formula. If you go into further math, and if you were in the class that when Dr. Holmes was gone, what's actually really interesting, I'll draw the same thing. This is $1,000. These are smaller coupon payments. So these are bags of money, right? Your duration is literally, if this was a lever, where it's your weighted average. It's where this would balance out. So it's your average time of getting your money back. And so that's why smaller coupon payments move it this direction, right? If you have smaller coupon payments, it's going to be weighted heavier here. So you're going to have to adjust for that. So that's literally what duration is solving, but you do not have to solve for that.
So duration would be like a break-even point for a bond.
Yeah, but you're not physically getting the cash back, but if you could like smooth it out, like on average when you would got your dollar. Yeah, exactly. Yeah, you can think of it that way. Yep. And so it's affected by length of time and this, but this will give you a number. This will be like 8 years. So know that as well. Duration could be told to you it's a duration of 8 years. Don't get confused by that. It's still just this multiplier. It's just this number, even though it's measured in years. It's just a number. No, these are the actual years. So this is a bond that's maturity is 8 years and a bond that's maturity is 10 years. But what I was saying is it is possible that this fulcrum thing with coupon payments, that it could have a duration of 7 years. Okay, this is the duration where it averages out, and that this 10-year one is 6 years. That is possible because of coupon payments. So just because if you see a bond that's longer, it doesn't necessarily mean it has a longer duration. Even though that affects it, coupon payments also play a role. So if these coupon payments were really large and these were really small, this could have a longer duration.
So is there a specific benefit to having a longer or a shorter duration within our bond?
Yeah, it's less risky because if I'm getting $30 back versus $60, I want my money earlier. Okay. Is Anna here? Okay, perfect. So we're going to switch TAs. So while she's getting ready, I'll answer some last questions on.
So just to clarify, is the duration how long it takes for you to get your money back in coupon payments? So let's say
I would.
it's $1,000 face value, and you get coupon payments of, I don't know, let's say $100 a year.
And you'd think that it'd be 10 years?
Maybe 20 years. Would the duration be 10 years?
No. It's just Yeah. Yeah, that's not right. But I mean, it's kind of it's a weighted average. I mean, this is how I kind of learned it and makes sense to me. Like I was in one of my finance classes beyond 201, we were talking about duration, and I looked up and I found like a YouTube thing and it taught it this way. I was like, oh, that makes a lot of sense. It's where do they average out? When do you, on average, get your money back? But it's not, it's confounded by time value of money. Did you have a question? Where did Anna go?
You like calculate that. Like you said, the coupon.
You don't have to.
Time.
But what you would do is you would just do, this is year 1, this is year 2, and it's, let me think, total cash, I'm getting 30, but the total cash I'm getting $2,000, so I weight it and then I times it by the time. So it's 1 year times the amount, the value that this is. But you have to discount it all back first, and then, so you don't need to worry about that. So you can start hooking up, I was just answering, yeah. Yes, you're right, that you can do that. You can even like blank it so no one sees your email password. Yeah, you don't have to solve for it. Yeah, even that they'll just ask you how much is the price going to change. It will always be given to you. Yeah. So they know it's going to be, yeah. So we're going to, Anna's going to go over things she prepared. She went, so we might be covering things on topic 7, 6, and 10. So I asked them at first, like what they want. 7 first, you can do that too. You can like see what chapter they want to focus on.
Okay.
Or you can just go through your steps.
Alright,
Just go through steps.
Alright, thanks.
Do you want dual screen or just your?
Yes, I didn't. Probably just. Well, could we keep this up? And
Yeah, you can.
I didn't plan on using it. Okay,
But if
sweet.
you want to or something, I have some papers in here, but I don't
Thank
have.
you.
No.
Did you just look at this?
No.
Okay.
No, this is for an interview. Yeah.
Okay, and so I just click through on your computer, right?
Huh? Yeah, and we'll plug the 5.
Okay. Okay, can everyone hear me? Yeah? I'm Anna. I'm really excited to be here to review these chapters with you. Let's think. So my take on this is that the math isn't too difficult. You've done a lot of difficult things already with the time value of money and so on and so forth. And if you really understand the conceptual parts of these chapters, you'll be able to take whatever he throws at you on the exam. So I'd really like to focus on the conceptual things and make sure you understand every different part so that when you get to the test, nothing will be new to you. And I have it supplemented by a few different problems. By raise of hands, who has gone through like the practice exams on My Educator so far? Okay, so a good bit of you. I would really, really recommend doing that, especially after this review, when you feel like you understand more of the conceptual things, so that the problems will become easy to you, and that will definitely help you with the exam. How do I get this to show? So first of all, for my spiritual thought, I really did want to say that as long as you feel good about your efforts in studying, you don't come out of the test and say, well, I should have studied a lot more. And as long as you're keeping the commandments and praying, everything's going to be okay, no matter what you get on the test. So that being said, I'd like to start with chapter 10, since I find that there are conceptual things that are a little bit different with that. Make sure that you're sitting close to someone, and please be prepared to participate, because I'm going to be asking a lot of questions, because I find that questions help people understand a lot better. First of all, who can explain to me what risk is? What does risk mean? We use it so often in finance, but what does it actually signify? Yeah. Exactly. The probability of something occurring or the probability of something changing. So when we talk about any sort of risk, we're talking about how something is going to change. Sorry, it's a lot better with the PowerPoint, I promise. No, you're fine. You're doing so good.
That's all you guys need in the test.
That's so weird.
Do you know why on my screen it's different than on that? Do you have any clue? No?
He's like, no. Should it be the control key for that?
I'm not sure. Yeah, here you go. So you want to duplicate?
And enter. Okay, thank you. Okay. Thank you. Okay. So, okay, great. What is risk? How much something changes? So what is operational or business risk? What have you understood from the reading or from class? What is that? Maybe take 15 seconds and discuss it with your neighbor or anybody close to you, or think about it. Can I post my slides? Yeah, we can. Okay, great. So who can tell me what business or operational risk is? Nobody? Yeah, thank you. Okay, good. So it's more thank you so much. It's the risk or the probability of how much your EBIT or your operating income is going to change. What's the difference between EBIT and operating income? Nothing. They're the same. And a slight note, like Cameron said before, you should know how to calculate that, know what things make up or get you to EBIT. So then what things can affect your operational or business risk? Take 15 seconds and discuss it with somebody or think about it. What kind of things are going to change your EBIT or your operating income? Okay, awesome. What kind of answers do we have going on? Sales, exactly. If your sales go up or down, that's definitely going to affect your EBIT or your earnings before interest and taxes. What else? The competition, the costs. Yeah, exactly. So all of these things will be affecting whether your EBIT goes up or down. That's your business risk, how much it's going to go up or down. So let's look at this last one, operating leverage. We need to focus a little bit on that. So what is operating leverage? Who knows? Yeah, in the back. Okay, thank you for saying that. So we're going to get to that a little bit later, but these things are easily confused. Operating leverage is different than financial leverage, which is what you just described. But operating leverage is your use, this is taken right out of the book, use of fixed operating costs. That's to say like your rent or the taxes you pay on property or the salaries that just don't change from month to month, as opposed to your variable costs. So what kind of firms have high operating leverage? Think about it. What kind of firms have high fixed costs as opposed to higher variable costs? So discuss it with somebody next to you. Just think about actual companies that would have high operating leverage. Okay, what kind of companies? Just shout them out. Airlines, exactly, like Boeing, tons of property, plant, and equipment. Those are high fixed costs. What else? What was that? What's a service firm? How would you define that? Okay, great. Yeah, like utilities, services. Yeah, great. Thank you so much. So companies that aren't going to have such high fixed costs, fixed costs would be like Facebook. They don't have a lot of those property, plants, and equipment, those fixed assets. Great. So how does operating leverage affect business risk? Knowing that business risk is how much your EBIT is going to go up and down, and knowing that operating leverage is the amount of fixed costs of your business, think about the relationship between those two. Talk about it with somebody next to you. Okay, great. Do you have an answer in the front? Yeah. How would it change, or how would it affect it?
It would increase risk.
Great. It would. Yeah.
Depending on if you have a ton more sales and you have mostly fixed costs, then the graph you'll get a huge operating income. As compared to if they're both fixed costs and if you have a lot of variable costs, then for every product you sell, you'll rack up more costs.
Exactly. Thank you. So if you couldn't hear that, if a business with high operating leverage is going to have a high and a lower low when it comes to EBIT. Like if the sales decrease, then the costs don't decrease because it's not variable, right? Darn. Could we have someone else re-explain it as well? Since I don't know if my explanation was good enough. So I want to see if you've understood. Could someone explain it back to me? No? Yeah.
I would say it's kind of like a ceiling. If you go up past a certain point across your operating costs, everything past that you're going to make money because it's above the flat yellow line of the fixed cost. But the other cost, which is going to kind of be, like you were saying, kind of directly proportionate. For every shirt that you sell, that's $5. You're going to pay $2 for every shirt.
Mm-hmm.
Doesn't matter if you sell 1,000 or you sell one, you're still going to have to pay for every shirt. Well, something is different than it's just a fixed cost. You sell a lot more, then you make all that money with no risk.
Okay, great. Thank you so much. So let's look at it. Let's take a look at it. If a company has a high fixed cost, then it takes them a lot longer to hit that break-even point where they've sold enough that they've paid off their fixed costs. And as soon as they get past that, they're making a lot more because they have lower variable costs. They're not paying as much out for every sale they make. And then on the other side, on the other hand, if they're not making a lot of sales, they can't get to that point where they're hitting their fixed costs. They maybe can't pay off all their fixed costs because they aren't making enough sales. So that's why there's a larger gap between the costs and the revenue, sales revenue, if they make a lot of sales, and then it's harder to get past that otherwise. And so this is a really good graph, I think, that explains that. Yeah. So I think that's referring to sales versus net income. Sales is the top line, and then net income is the bottom line on your income statement. But yeah, that's a great question. All right, so what is financial risk? That was answered by you in the back. Do you want to say it again for us? Right, so financial risk is, so it's again, something is changing here, and the thing that's changing here is your earnings per share or your net income, how much that changes because of the debt that you take on. So keep in mind that financial leverage means debt, loans, bonds, preferred stock, things that you have to pay off eventually. And so the higher that you have your financial leverage, the higher your financial risk, obviously. And remember that that is changing your net income or your earnings per share. Whereas what is business risk affecting? What's the line that your business risk is affecting? You can just shout it out. EBIT, good, yeah. So know the difference. It could save your grade. Oh, keep in mind that in the book it says fixed cost debt, not to be confused with fixed costs. So the wording is so similar. Don't get them confused. Fixed cost debt is just talking about the debt, like the long-term debt, and then fixed costs are your fixed costs. Okay. Okay, so the good news is we can measure both this operational leverage, the impact that that has on EBIT, and the impact that financial leverage has on net income through these two ratios, DOL and DFL. I'm sure you've seen them before, but now you know. We're going to learn more about what they actually are telling you. So first of all, DOL, which is the operating leverage ratio. Looking at, oh, that's too bad you can't see that super well. Can you guys see that? What if I tell you, these are on your equation sheet, so you don't have to memorize these, but you have to know what they mean. That the percent change in EBIT over the percent change in sales is the DOL. What is that actually saying? What does the DOL ratio tell us?
Tells us what rate the
Exactly. So again, it's a change. It's the risk. How much your percentage change in sales will affect your percentage change in EBIT. So how much EBIT is going to change based on your sales change. A high DOL means that the operating income, or the EBIT, is very volatile. For example, actually we're going to do example in a bit. So keep that in mind. Any questions up until now? Yes. No, you're not. Yeah, so the bottom is like how you'd calculate it using the numbers that you're given, but it comes out to be the percent change in EBIT over the percent change in sales. And like I'd recommend that you get up the equation sheet, so you can like follow along with these, because this is what you're going to be seeing on the test. Yeah, good question. All right, so DFL, if this is what DFL is, the percent change in EPS over the percent change in EBIT, what does that tell us? What is this ratio trying to say about our company? I saw you kind of had your hand up. Yeah. No? Yeah. Wherever someone was pointing to. Oh yeah, in the back, yeah. It has more to do with interest and taxes, but yeah, that's an answer. So the percent change in EBIT, it tells you how much your net income or your EPS, earnings per share, change as EBIT changes, right? So just look at the denominator. That will tell you by every percent change in EBIT how much your percent is going to change for EPS. Yes. Yeah. I'm gonna be honest with you, I wondered about that too, and I didn't have time to work it out before I came in. I'm really sorry. So, but Cameron, do you have any idea about that? Yeah, since they're clearly like not the same quantitative things.
So when you go down your income statement, you're going to do your EBIT comes first, then your EBIT over I gives you a number. But to interpret that number, like you'll say, oh, I have a 3 would tell me that a 3% change in EBIT gives me a 9% change in earnings per share, right? And so I did this example earlier, but like if you just reverse that, if you say what the percentage changes actually were, that 9% over 3% is also 3. So the formula will give you the 3 on the bottom, but then once you've solved for it, if you just go backwards, like the percent change of the latter over the earlier will also give you 3. So it's just algebra. I can answer questions individually if there's some on there.
Thank you. Okay, thank you so much. Yeah. Okay, so again, oh, I'm so sorry. I just like breezed through this. Okay, so the net, so it tells us how much the net income changes according to how much the EBIT changes. So do this with the person next to you, or you think about it yourself. If I tell you that your company has a DFL of 2, that's the ratio, what does that tell you? And if someone could raise their hand when they have an answer, that would be awesome. Yeah. Yes, you. Exactly. Thank you. So for what he said was for every 1% increase in EBIT, there is a 2% increase in net income. Yeah. Okay, great. So DCL is the combination of both DOL and DFL. It takes the numerator from the DOL and the denominator for the DFL. And if I tell you that our ratio is the change in EPS over the change in sales, percent change in sales, you should be able to tell me that this ratio will tell you how much your change in sales will affect your earnings per share or your net income. So let's do a problem then. Okay, everyone get out some paper and we'll work through this. So here are some made-up financial statements for Delta. Yeah, they're very made up. They have nothing to do with Delta. I'm sorry, Delta. If I tell you that the Delta's operating income increases by 200, then what effect will it have on net income? So as a good starting point for you guys, I would look at your equations sheet and ask yourself what ratio deals with both operating income and net income. So take a minute and think about that, write it down or start working on it, and then we'll go through it together. Sure. I don't know if this is okay. Okay. Oh my gosh. I'm gonna have to get a different pen. Yeah, I'm so sorry. Okay, so we're gonna start going over it now. First of all, what ratio should it have been? DFL, good. That's the one that deals with both of those things. So we know that this is our equation for DFL. It's EBIT divided by EBIT minus interest, and we have all of that information. Awesome. So we easily calculate our DFL. Now the next step is relating this to a change in EBIT. And we're going to use the other equation that we had, or the percent change in EBIT, or percent change in net income over the percent change in EBIT to find that. But first we need to calculate the percent change in EBIT. First of all, was anyone able to calculate the percent change in EBIT? Yeah, so tell us what you did for that. Awesome. And so that's the general rule for calculating the change in anything. You take the increase or decrease, and you divide it by the original number. And that's going to come up later as well. So we do that, and we calculate 21.1%. So our next step is to bring these equations together. DFL is equal to the percent change in net income over percent change in EBIT. So we solve for the percent change in net income by multiplying DFL by the percent change in the EBIT. So it's 1.73 times 21.1%, and you should get an increase of 36.5%. And if you have any questions about how we went through that, ask a TA. I also highly recommend going through the problems in the practice exam because there are many like this. All right, so moving on to chapter 6. Yeah, totally. I'm sorry. I'm just nervous. Just scrolling through. And I think we'll be able to like post these online afterwards. Any more questions on this slide, or can we move on? Awesome. All right, so for chapter 6, we're talking about stocks, and there are several ways to value stocks, and fortunately, you've done some of them already. So first of all, the single holding period. That means that an investor buys a stock and then sells it after 1 year. And fortunately, it's very easy to calculate. It's by using the time value of money formula, or you might have seen this formula on the book. The present value of that stock is equal to the sum of all the cash flows that stock gives divided by 1 plus the interest rate to the nth power. That's just what you're putting into your calculator. Your calculator solves this equation for you. Any questions about this equation? All right, awesome. So what kind of cash flows do we get from a stock? What do you guys think? Yeah, okay, great. Dividends and capital gain. Capital gain means you sell it at a higher price than you bought it. If you buy Disney stock and it's $25 and then it goes up to $35 and you sell it at that price, your capital gain is at $10. Yes, did you have a question? Oh yeah, he's answering. Great. So our question will be then is what return would you make if you sold a stock under that scenario? Let's pretend like, okay, so this goes back to what we were talking about in the slide before. To calculate the percent change or the return on anything, it's it's the price at which you sell it or the price at which you buy it minus the original price divided by the original price. So the numerator is just the change in the price divided by the original price. So just to show you an example, I'm sure this is all pretty basic, but like I said, if I buy a stock, it costs me $10 today, I sell it in a year, and it costs $20 in a year, then my percent return is 20 minus 10 divided by 10, which gives me a 1% return. So I made 1% on that transaction. If dividends are involved, you just simply add the original or the price at which you sell it to the dividend, and then you subtract the original price, like before. Okay, and we're going to do a problem that incorporates all of these things at the end of this section. So the constant growth model. First of all, when do we use this model? Under what circumstances? In a word problem, what would trigger you to think, oh, I need to use the Gordon growth model or the constant growth model here? Pardon? Long? Okay, yeah, I would say forever long, yeah. Yeah, exactly. So your dividends are set to grow at a certain rate for forever. So that's when you see anything that says that in the wording, you know to yourself, oh, I need to use the Gordon growth model to find the values of these dividends. So here is the Gordon growth model. The value of that dividend is equal to D1 divided by R minus G. And keep in mind that D1 means the future dividend. If the word problem says to you, Intel just paid out a dividend, or Intel paid out a dividend last year of this rate at this, or of this price, that should say to you, this isn't the number I'm looking for. I need to use this to calculate D1. So D1 is calculated by D0 times 1 plus the growth rate. And that makes sense. The dividend is going to grow at that rate, and so for 1 year, it's only going to grow 1 plus G. Okay, so let's do a problem. I looked through all of the bond problems in all of the world, and this was the hardest. Not really. But this is a pretty complicated one, but it's very doable. Given what you've learned and what you know based on these PowerPoints, you'll be able to do this. So first of all, I'll just read it to you. Due to recent advances in technology, dividends in Alpha Inc. are expected to grow at a rate of 15% for the next 2 years. You should be writing down these key numbers as we go over this. After this period, the firm is expected to grow at the industry average rate of 4% forever. The firm recently paid a dividend of $1.50, and the required rate of return is 8%. So I'll give you a second to just write down all of those things because they're all pertinent. Okay, so the question is, what is the most you should pay for this stock? What is that question actually asking us? What does it want us to quantify? Yeah, the present value of these dividends to tell you the worth of the stock. Great. So we'll do it part by part. The first part is going to be those 2 years where it grows at a huge rate. And then the second part will be the constant growth rate. So here's just a little tip. You use the time value of money equation to find the present value of all of the dividends. Keep in mind that here are your numbers. So for example, the future value, we need to calculate D1, not D0. It recently paid that dividend, so it's kind of irrelevant to us. But we use that 150 and we calculate what that dividend will be in a year, which is 1 plus the growth rate, 1 plus 0.15. So that gives us 1.73. Then you use that as your future value and you apply the time value of money and find the present value, which is 160. So go ahead and figure out the second dividend, the present value of the second dividend on your own. I'll give you a minute to do that. Yeah. Okay, so the answer, the present value of the second dividend should be 199. If anybody got that, could they tell me how they got that? Yeah. Mm-hmm. Good. Perfect. Thank you so much. So that, yeah.
Is there anything against the rules by just pressing plus 15% equal sign, or is that not going to give us
Is-
the calculators have no percent?
Are you using a financial calculator? Okay. No, there shouldn't be anything against the rules for that. Great. And then the present value of that brings us to 171. And so when we add those both up, the present value of all of those future dividends are going to be 331. So that's for part one. That's for those 2 years of really high growth. Now we're going to look at the second part, which is the constant growth. So as a little hint before you get started, actually we might work through this together, but so calculate the DI using the dividend from year 2. Use that to calculate your Gordon growth model rate. So once you finish the Gordon growth rate, then we'll work on this together from there. So take a minute and find out what the value of this dividend will be. So does anyone know? Yeah. Right. Okay. Good. Sorry. Does anyone need to see any of the information? Yeah. I mean, I'm just going off the Gordon growth model. Yeah. I see what you mean. Definitely. What do you need to know? One of like the parts of the. You good? I believe it was a growth rate of 4%. 4%. The market rate was 8%. Okay, who's been able to calculate the present value using the Gordon growth model? Do you guys have enough time to do that? I can't tell. So, so D3, so the next dividend should have been 2.01, and you're using that constant rate now instead of the 0.15 from before. Then we use that to calculate the value of the stock. So the equation is D1 divided by the market rate minus the constant growth rate. So you should have gotten 51.75. All right, for this next part, we need to find the present value, but we need to keep in mind that in calculating the present value of this quantity, we use n minus 1 for the period. And we can get into the math of that, but it's just easier to accept that when you're going back using the Gordon growth model, using time value of money, you use n minus 1. So those should be, like when you think Gordon growth model and finding the present value, it should be n minus 1. Those things should go together in your mind. So I'm sure that you know how to do that. So the present value is so the answer is 44.37. So then you just add the present value of part 2 to the present value of part 1, and that'll give you the total value of those dividends and the price that you should pay for it. All right, so one more chapter to get through. So first of all, I'm sure you've gone over these a lot, so this should be pretty simple. Let's go over the keywords and concepts. First of all, what kind of cash flows can you expect from a bond? Yeah, the interest or the payment. What else? Yeah, the lump sum at the end. So we have these two, the face value, which is the lump sum that you'll get at the end of the bond's life, as well as the coupon payment times the face value, or the coupon payment, which is the coupon rate times the face value. The only time you ever use a coupon rate is by finding the coupon payment, which is like the semi-annual or the annual payment. And after that, you don't use it for anything else. So don't be confused by that with all of the other interest rates or yield to maturities that you have. How long will a bond last? What's the name of the life of a bond? Maturity. Awesome. What kind of return can I expect? So the day that you buy that bond, your issuer says, oh, and here's the return of your bond according to the market rates. Do you know what that's called? Yeah, exactly. The yield to maturity. The return you'll get if and only if you hold it to maturity. If you choose not to hold it to maturity, that will change. So it's a set rate, and it won't change for that bond, but we'll talk about when they do change. So who's deciding all of these things? It's the buyer, and then the seller will sign a contract called an indenture that states all of these criteria for your bond. This is duration, but I think that Cameron went over that really well, and you can look at these slides later. Anyway, so as we said, while the yield to maturity of your bond that you buy doesn't change, the interest rates or the yield to maturities can be changing in the actual market. So the question is, how do these changes in YTM affect your bond that you've already purchased? Does anyone have any ideas about that? Can't say. Yeah. Exactly. That it affects the price or the value of your bond if you want to sell it at a certain point. For example, as you know so well, as the YTMs in the market around you are changing, or as they're decreasing, the price of your bond is going up. That makes sense. Your YTM was here, and maybe the market's was here. Now it's decreasing. Yours is higher valued. Yours will have a higher yield. That means that the price is going to go up. And then conversely, if the yield to maturity of the market goes up, then yours is worth less. Worth space less. Yeah, great. And now, so it's important as well to know, can you guys see that? No, a little bit, like the last 3 lines on that little graphic. I can't tell. Okay, so another important thing to know is how the coupon rate and the yield to maturity affect your bond price. So maybe take 10 seconds and talk to the person next to you and see if anybody can describe how these rates affect the price of the bond. And this is the yield to maturity of that original bond that you purchased. We're talking about the price of the bond at the time of purchase. Okay. Sorry, my dad. Yeah, what's up? Yeah, sorry. So the equation for current yield, which I thought I wrote down, but I didn't. It's the coupon payment divided by the current price of the bond. Yeah, it's the coupon payment divided by the current price of the bond. Yeah. Yeah, thank you so much. So it's the annual coupon payment divided by the current price. The current price of the bond. And if you have any questions about current yield, I would go through it in the book, or even just like find a YouTube video on it. I think that's a very useful way of learning these financial principles. Okay, so in resume, we have if your coupon rate is higher than the yield to maturity of your bond when you buy it, that means you're getting a really good rate on those monthly payments, which means that the price of your bond is going to be lower to account for that. So I don't know if you can see it, but if you look at the last line in this little orange box, it says the coupon rate greater than the current yield, greater than the yield to maturity, the bond price is greater than the face value. I think I said that wrong, for which I really apologize. So on the other hand, yeah, I'm so sorry I said that wrong. So the yield to maturity is lower than the coupon rate. That means like the yield of your entire bond is less than the yield of the monthly payments that you're getting, which isn't as great of a deal, which means that your bond, or which is a good deal, so your bond is, no, did I say that right? I'm so sorry, guys. Okay, let's talk about, yeah, what was that? Yeah, exactly, because you're getting more payments. I think I said it right the first time, but I'm really sorry about that. But if the coupon rate and the yield to maturity are the same, then the bond current price is going to be the same as the future value. And then obviously, like logically, the next step would be if the coupon rate is less than the yield to maturity, then the bond is going to be priced lower. It's a discount because they know they're not giving you as much annually or semi-annually, so they have to sell it at a lower price. So I would memorize this order: coupon rate, current yield, yield to maturity, and then just know how those affect the bond price. And you can find this graphic like online if you search it, or like I said, this PowerPoint will be on Learning Suite. All right, so finally, let's do this bond problem. So a bond has a maturity of 14 years, a coupon rate of 11%, and was sold at 953.52. So already we know that the price of the bond is discounted. What can you say about the yield to maturity? Right. Yeah, so if we look back here, we know that the coupon rate, we know that the price is less than the face value. That means the coupon rate is less than the yield to maturity. So that's a good way to check your answer. If you get an answer that is lower than 11, you know automatically that something went wrong in your calculations, because the price of the bond tells us that it should be higher than that. So the interest is paid semi-annually. What is the yield to maturity at the time of purchase of the bond? So take a few minutes and work through that. Okay, let's go through this. First of all, can anyone just tell me what will our N be? Yeah. Okay, before I show you this, I want you to know that I'm pretty sure I made a mistake on the calculations. So trust your work, not mine. I'm so sorry, but I love you. Okay, so N is 28 because it's 2 times the maturity. Great. What about our interest, or what's the coupon payment? Yeah. Okay, yeah, I'm really sure that I did this very wrong. It was late. Good. So, can you see this? Nice. N is equal to 28, is equal to 0.11 times 1,000 divided by 2 to account for the semi-annual. We know the present value, and it has to be negative. It's 953.52. And and then the future value is 1,000. So could anyone tell us what they got for the rate? 1168, and that was that before you multiplied it by 2? Okay, great. Sorry, what was that? Oh, okay, so yeah, 5.84, thank you, times 2 to get that. Good. Thank you for doing what I could not. Does anyone have any questions about that problem? Anything like that? Okay, so we finished a few minutes early. Totally willing to stay and answer any questions that you guys have. Yes?
Sorry to jump on that.
Yeah.
There's one part you said that you covered really well. I was just coming to go over that again.
Yeah, the duration? Yeah. Okay, so basically the duration is how long it'll take you to make back your money that you spent. That doesn't mean that you get it back, but like you're getting these payments, so how long will it take you to get your payment back, essentially, through these coupon payments? And so just keep in mind that the duration is larger when the maturity is longer, and the bond has smaller coupon payments. Also, keep in mind that you should review the different types of bonds, like the names, like the vocab, the names of those bonds. Oh yeah, and the differences between preferred and common stock. Those are very basic. You can look them up in the book or YouTube it.